Welcome back to Financial Independence 101. Today I want to talk to you about the possibility of the Fed rate cut in September, a quarter of a point, what this would mean. Would it mean anything? What would it mean if they started a series of cuts in September? Why are we waiting until September? Why do they want to start it as soon as September? But I want to say, I'm going to point a few things out that Jerome Powell has done well, and then I'm going to tell you what I think if he does cut it. We're going to get into this. We're going to look at a little bit of just some dry text, kind of seeing what's going on, and then look at some fun charts. And then at the end, I'm going to draw a few conclusions. We'll get into this and more coming up. All right, Reuters on July 25th, talking about the Federal Reserve policymakers are leaving the short-term interest rates in the 5.25% to 5.5% range for the next week and waiting until September to start a string of quarter-point reductions. Now, they're not guaranteeing that we're going to do one in September, October, November, and 3/4 of a point, but they did allude to that earlier in the year. There would be 3 rate cuts, and that it might be premature, and I'll show you why. But the traders have priced in about a 9% chance of a rate cut when the Fed meets next week, but it's knocked down to 7, so almost 0% chance that they'd cut it prior to September. Now, they're saying that the economy grew at 2.8% pace last quarter. I do want to say 2.8%, and then depending on the inflation, that's still below inflation, meaning it's still negative output versus last year. And you also have to say it's negative output versus last year, but we've also seen a huge rampant inflation. Inflation's a big deal. Also, they're saying that inflation is slowed to 2.5% for the 12 months, which I'm going to show you where they have inflation. I've got that chart. We're going to look at that, but it's closer to 3% still. And 3% is not their target of 2%. In fact, there's no reason to have a target of 2% other than the fact that the government is deep in debt, and if we don't inflate our way out of debt, then we could not overcome that hurdle. But inflation's not under control, but that's another thing they're trying to say, that it is. So here's a chart of inflation pretty much for the past 5 years to kind of get an idea of where inflation's been over the past 5 years, and it's settled down to 2.97. If you look at it a full exact year ago, in June of 2023, it was at 2.97, but yet they still didn't decide to do cuts in the future. They're expecting inflation to be at 2.5% or closer to 2 by September, and that will give them the excuse to cut. But that's not really what the problem is. It's not that they really have achieved their 2% inflation. They beat inflation, like we beat Medicare, whatever that was supposed to mean. But that they didn't really beat inflation. They can't afford the interest at the high 5%. Friday hit a new milestone with the $35 trillion number. Yes, $35 trillion is what we hit in debt. And honestly, I'm just going to be honest. I thought we'd be pushing 50 by now with Democrats in charge. And that's just the reality because of the excess spending that we usually see. Now, the reason it's taken them this long to get to the $35 trillion, and it was last Friday, is the fact that we have gridlock. There's Democrats in the Senate and Democrats in the Senate, Republicans in the House, and they basically have gridlock on spending bills. Plus, we have an election coming up, and they don't want to look too fiscally irresponsible. Just save that for after the election, all that kind of stuff. And the reality of it is that after the election, we're going to see this debt just skyrocket, and they can't pay the interest on this debt. So what is the expected interest on this debt if we continue with 5%? All right, so they're expecting it to be about 1.1 trillion, 1.14 trillion in 2025. Now, let's explain this. If it was 5% of 35 trillion, you're looking at 1.7 trillion in interest payments alone. It's called servicing the debt. And the fact that it's 1.1 is because not all of the debt has matured at that point. But 2025 is going to have a lot roll over. It's going to go from 1.1 to, by the end of it, 1.4. And eventually, just a few more years, it'll be approaching that 1.7 to where a lot more of the debt has rolled over. That is the real reason they're cutting. This is the real reason they're cutting. It's getting up to, this is almost half of the receipts taken in from taxing individuals. So taxing you, now they tax multiple different ways. There's several different revenue streams, but it's half of income tax from U.S. citizens. It's going to go to just paying interest on the debt. Think about that. That is absolutely crazy. This kind of shows the treasury yields over the past 6 months. And treasury yields are down. Now, one of the things is that we are existing inside of an inverted yield curve, meaning that you get a higher interest rate on a shorter term. This is a 10-year, but the 2-year, in the 2-month, in the 3-month, is actually a much higher rate. Well, at least 1%. That spread means that every time we have that inverted yield curve, to where a long maturity, like going out 10 years versus going out 2 years, is much lower than a short term, means that there's concern about the future of our economy and the future of stability, and that usually leads to a huge downturn in the markets. Now, we will see a rally in the markets if we get this September rate cut, especially if we get in October and in November. It'll just fuel the market. But then January 2025 is going to come in, and we'll probably see some crazy stuff happening. Now, I really do think that after the election, there's no reason to keep the dog and pony show going, no matter who wins. No matter who wins. Trump wins, or Kamala's not actually the candidate yet. They haven't had their Democrat convention and given her delegates yet. But, I mean, they don't really care about due process. But whoever does win, I think the rug's getting pulled out next year anyway. So another reason that this is happening, this is a major concern. Lots of banks in the U.S., it's anywhere between 300 and 1,000, are on the brink of failure. And they're just barely holding it together. There's a new way of handling bank failures, but the FDIC, if they take over a bank, of course, would still give you the money, but that's more printed money. That's going to go towards the debt, and then that's more interest they're going to have to pay on having to come up with the money to pay citizens or pay people that have depositors. It's going to raise the debt and then raise the cost of interest on that debt. But I've already made a video about this, and I really thought more people would be interested in bank bail-ins, but evidently people are not at all interested in bank bail-ins. But once it starts happening to them, they're going to go find my video and it get explained to them. But it happened to me with GM. I lost 20 grand. Great. That's fun. But it's going to happen with your bank account where you plan to pay bills. You've worked for 30 years. You've saved your life savings. You're under the $250,000 threshold. And it's worded as, it's really interesting that you're going to bear some losses. Depositors bear some losses incurred by the bank. Instead of relying on external funding, such as the FDIC, the bank uses its own funds to recapitalize itself. Bail-in involves canceling debts owed to the creditors' depositors. Basically, they're going to give you some of their worthless stock, and then instead of you having 100,000, you have 60,000 and 40,000 worth of worthless stock. Now, the other reason that they're going to want to do this is because they're seeing a crisis. There's an auto repo crisis of repossessing cars, and I couldn't find the best chart on that, and I really feel like this chart is seriously understating what's going on right now with mortgages. But we're looking at 08 levels. We're going to be looking at 08 levels of serious problems with mortgages. And the default rate on mortgages is going through the roof. So this is defaults on mortgages. But when this spikes, I mean, it's going to have a huge spike, and they're lowering interest rates so people can refinance, and there's other things that could be done. But that's not going to happen. It's going to take 18 months, like it did for this to max out on the way up. But on the way down, it's the same thing. Even if they lower several times a year, 5 times a year, and like they went up, this is not going to correct itself very fast. You're looking at into mid-2026 before we start to see this pressure alleviate. And lastly, I forgot this guy's name. All right, look at it real quick. Brandon Biggs on March 14th predicted Trump will be shot. Now, his prediction was that it would go right by his ear and it would destroy his eardrum. And then he said a few more things that it's really interesting. I really don't believe a lot of these prophets, and somebody came out saying he's a false prophet, but it's just really odd that he was spot on with the Trump assassination attempt. And he even predicted right ear going right by the right ear. And I might make a whole video about that. But it's not so much the assassination attempt, because if that's proven right, he goes on talking about how Trump is going to become more holy and spiritual, and it'll strengthen his relationship with God. And then Trump's going to win the election, but then there's going to be a depression, a 1929 level depression in the U.S. It's just an economic prediction he predicted, and it's not really very hard, because if you look at all the stats and all the numbers, they're all predicting the same thing this guy predicted. So it's not really that hard to predict that, but it's almost impossible to predict that a bullet's going to go right by his right ear, and then he's going to fall down and have some sort of a come to Jesus moment. I thought that was impressive, but we live in strange times. So to sum it up, I think Jerome Powell did a great job when it comes to raising interest rates. A lot of people give him a lot of crap because he does not give any policy advice to the Democrats or even to Republicans. And he doesn't talk about you need to be cutting spending. And I would like to see him say, we need to cut spending. My job's really hard trying to figure out how to come up with money for you guys when you're spending it faster than I can produce it and I can print it. But the fact that he's lowering it, I think it's way too soon. I gave you the reasons why it's too soon. And at the end of it, we could see rampant inflation. And if we do have this circumstance where we have a depressionary situation, but yet they're still spending too much money, we can see hyperinflation. And that is the worst case scenario. And we don't want to see that. But let me know what you guys think about this in the comments below. Like and subscribe. Financial Independence out.